Good morning, good afternoon, and good evening to all of our crypto fans and listeners and viewers. You have your typical, I was going to say threesome, but Robert, Carlos, and Matt Reed on the line over here talking a little bit more about crypto markets. Gentlemen, oh man, Matt, I almost thought for a second you were drinking some liquid death.
Oh, after last week? No.
Yeah. No.
Daisy cutter. It's good.
That's nice. Looks pretty good.
I can't bring myself to pay that much money for water. I saw it in the shop. I was like, no.
Yeah, Haley actually saw Liquid Death at Whole Foods and was like, I'm going to get some for Matt.
Like, no. What is this garbage?
Yeah.
Dude, what you got over there, Carlos?
I'm sticking with another slice of Americana this week. I'm going with Coors Light.
Mixing it up.
If that mountain's glowing, I'm gonna crack it open. So
beautiful, because you can't ever tell by touching the can. You need a visual aid.
No, you need it. You need that can with the built-in feature to tell you it's cool.
When you've been crushing so many ice cold beers for so long, you can't trust your hands anymore. You need a visual.
It's true. It's true. It's a brilliant invention. Whoever came up with the idea probably deserves some sort of Nobel Peace Prize or equivalent award.
Beautiful.
So good job.
I hope they patent that technology. Although I'm
sure they have.
It pales in comparison to, I think it was Bud Light. They had the ultimate drinkability, the spiral, so that it can spiral down when you're shotgunning beer. Remember that? The bottle?
No, I don't remember this.
They had it was a Bud Light bottle. I think it was Bud Light, and it would have grooves on the inside to allow the beer to swirl out more smoothly for ultimate drinkability.
They rifled the can. Wow. That's well
done.
They
rifled, yeah, exactly. Yeah, I mean
I love it.
That's up there with the blue envelope for Coors. Gentlemen, some news going around in the crypto markets. Maybe we could.
There's always news. There's always news, and there's always a 5% sell down.
It's like every Friday.
It's just immutable facts about the crypto world. There's just some new thing out there that's going to make the market sell off by a couple percent, and you just got to be quick on the draw.
But should we start with that, because that one was funny today?
Yeah, I'd love to actually.
We should get like a spin wheel, and for all the topics, just do like a random spin. Start it off like a randomizer.
No, it was funny because literally the minute that we stopped recording last week, I whipped open my phone and it was like, "Oh shit, there's a coup going on in Russia." So,
was that a positive for the crypto markets or a negative?
It sold off briefly, and then
yeah.
I think it just came right back because everyone's like, we don't really know what to make of this. And to be honest, a week later, I still don't know what to make of it.
Well, because then they apologized as well. Like, it wasn't a coup, we promise. And it's like okay.
Trust us, nothing going on over here. Yeah.
Psych.
Yeah.
So that was wild. Oh, we could just to kick things off. There was some news. This isn't super new, but that was a really interesting topic because it touches on a lot of the regulatory events that have been unfolding. A16Z announced that they were forming their first offshore office outside of the U.S. in London. And Andreeson Horowitz said that they believed London was the most abled city to be the future capital of blockchain or crypto markets, given some of the more favorable regulatory environments over there in the UK. I know obviously UK is the number 2 behind New York, or perhaps in line with New York in financial markets. So it seems like it's a prime city. I know, Carlos, you covering FX. It's definitely a big hub over there.
Yeah, I mean, London is the center of the FX market. So, I mean, New York kind of rules the roost when it comes to stocks and fixed income products, just because our debt markets are so large. But when it comes to FX, which is the largest financial market in the world, London's been that way for ages. shows no sign of slowing against New York. So it's not super surprising to me that one could look at the FX market as sort of a proxy. And I'm a little biased because I come from an FX world where all roads eventually lead to London, but it would not surprise me if London ended up becoming a hub in this world, especially from a trading perspective. It just makes the most sense. There's a little bit of skeptic in me as well that basically sees that, like Chris Dixon, who's one of the partners over at Andreeson Horowitz, who led a lot of the Andreeson Horowitz investment in crypto, might also, once again, slight skeptic, might just be afraid of getting indicted, and so he just decided to move to London. Because I think Andreessen Horowitz actually pioneered the idea of using retail as exit liquidity for insider tokens during the last, Web3 boom. I think I'm of mixed opinions about the value that, a lot of these VCs added to these projects. And in some ways, I think it would be a good thing if, as suggested in the McHenry bill, that we have legislation that basically limits the degree to which, insiders and VCs can sell off their tokens they get for pre-mined events, pre-decentralization. So I look at this news with maybe like two parts. Yeah, this makes sense because London is a hub. It will be a hub. Their leaders are being very proactive about, creating legislation and tax codes that make it friendly for, crypto innovation. And then I also look at with maybe like one part, these guys are trying to get out of Dodge and look for a friendlier, jurisdiction that's not necessarily going to come after them for some of the bullshit they pulled in the last bull market.
It's, and to be honest, it's probably both.
Yeah. It's smart. It's tactical. I think it's good. And then, obviously there's a little bit of cynic in me, and maybe you call me a hater because that dude personally printed fucking like 3 billion on the last bull market, but mazel tov.
Mazel tov. Yeah. And to be candid, I'm not sure how large that office is even going to be. It just hit a lot of headline press. It also could be Andreessen Horowitz's way. I interpret it also as their way of trying to push regulators, saying, "Hey, we're going to be moving jobs. Pay attention to this," kind of a way of grabbing headlines. There is no release done on the size of the office, so it might just be a small one that could be using it as.
That's a good point. So I don't think they've actually put through. There's plans in the pipeline for softer regs, but they haven't actually pushed anything through that would materially change the marketplace, at least in the UK. They're actually trying to adapt to it more like in the EU right now. That's kind of what they're trying to get through.
Yeah. I guess full disclosure, even internally, Matt and I have talked about, if things continue along the path that they were heading on, we might need to, pick up shop and, set up a UK entity for a lot of the same reasons that I read about in the article, right? Like, we know it's going to be a global hub. Full disclosure, I think the talent pool in the UK with regards to like quantitative talent and other stuff is just as good, if not arguably, better than you'd find in New York. There's a lot of compelling reasons to be in the UK. Not to mention, our resident Brit, is has citizenship, and that makes life easy.
I only have 2 words for you guys: shepherd's pie. That's all it would take to get me over there. That's right. What about other news that's non-US related? HSBC. Something came out too. Some news about them.
Yeah, I guess big UK bank. That was the Hong Kong ETF space that they've just grabbed that market. Well, they're huge in that area anyway, but they kind of grabbed the ETF market by the horns and are now offering Bitcoin and I think ETH as well. over there.
Yeah.
So
Can you classify HSBC as a UK bank? It's like technically called Hong Kong Shanghai Bank.
Just drop
It's
that.
like
well, it's an entity within HSBC Global there, I think.
Yeah.
It's like DBAG and DB New York type thing.
It was actually really funny. I was talking
DB
to
Singapore.
my wife because I've got a good friend that moved over to TD, and she's like, and I use the term Toronto Dominion Bank, and she's like, hold on a second, you're telling me TD Ameritrade is fucking Canadian? And I was like, yeah, it is.
That's why they use the acronyms,
Mm-hmm.
Exactly. So that's interesting. Yeah, a lot of ETF news, huh? I know that obviously there was a whole slew of ETF launches after BlackRock came out. Saw Fidelity also was made a filing as well for ETFs. Well, how many does that make it now? There's like I want to say
I think
8 or so that registered just within the past 2 weeks. It's crazy.
Matt shared a really nice graphic in our internal chat. So we've got ARK Investments,
missing Fidelity.
Yeah.
Oh, no, it does
ARK
have it
filed on April 25th. BlackRock June 15th, Bitwise June 16th, Invesco June 20th, WisdomTree June 20th, Valkyrie June 21st, and Fidelity yesterday, the 29th of June. So you're going to get a pretty tight cluster. In fact, I actually saw an interesting note.
ARK right today.
Yeah, ARK actually, and this is an interesting one. So one of the things that the BlackRock did to make the SEC more comfortable with their filing is they basically put in a clause that allowed them to share surveillance with the fund, the exchanges where they were going to partner with for liquidity. Now that's actually a pretty notable thing because if you think about the reason why the SEC has been slow to approve, or rather, let me restate that, why they have been so actively rejecting all spot ETFs is because their concern, which is stupid and invalid in my mind, but maybe let's just play devil's advocate here. Their concern is that the spot market can easily be manipulated, especially when you have these types of like fixings that happen where they basically lock down the price and then determine the price at which the subscription redemptions to the fund can be made. Mm-hmm. Their concern is that could be gamed by having it on a spot exchange that wasn't monitored fully. So BlackRock basically said, well, we're going to have shared surveillance with the exchange that we use to determine the reference price, so that we can make sure that we've got some sort of way to validate that these are actually like trades and not just people spoofing the market. And that's a feature that like any of the futures ETFs have, is like they basically have shared surveillance and proprietary technology on both SIBO and CME that monitors like the trade volume that happens there to make sure it's pretty above board. So the fact that BlackRock put that in there basically was their nod to the SEC that like, we acknowledge your concern and this is the steps that we've taken to mitigate that. ARK Invest updated theirs to include the same clause. So that effectively kind of put them in the driver's seat because they applied earlier. And I think the next date in which the SEC owes them comment is August 13th. So I think that we had all sort of been planning on, September being a date where it's like, okay, that's when we're going to start hearing from the SEC, but that's kind of moved the timeline up a little bit towards August. So now ARK's in the driver's seat, but then you have a very tight cluster of, basically the who's in asset management in right behind it.
Can they, like, if any rejections start coming in, Fidelity's now at the back, can they amend updates as quickly as they like the day before the 45-day review time, or is there some period? So I just think it's a good to be at the back could be good because you learn all the mistakes of the guys failing in front of you.
I mean, yeah, exactly. And generally, they're only 2 weeks behind. So in the grand scheme of things,
it's not a lot.
If we're doing it, I've actually heard some scuttlebutt that Fidelity is doing a ton of retail volume right now as it currently stands on their offering. And like in line with other major venues, except for they just don't publish them. So if you think about the distribution, like Fidelity has zero marketing going on right now, and they're doing a sneaky large amount of volume simply just by plugging in, their crypto offering into their existing distribution base. And the word is that they effectively have a reasonably large marketing spend to get behind this once they get approval. So imagine the distribution of someone like, Fidelity, BlackRock. I think BlackRock's more like institutional distribution.
They don't have retail. Yeah.
And Fidelity is just like, imagine anyone your parents' age or older has a Fidelity retirement account, and them being able to hop into some small bit of crypto out of their IRA is massive.
Yeah.
So
this
could get large quickly.
Yeah, I really think that Fidelity has a little bit of an upper hand. I mean, you see all the regulatory uncertainty. Institutions have been slow given some of that uncertainty. And I don't think even a spot ETF approval is going to really massively sway institutional status regarding to their interest in getting involved. But retail, certainly, right? So Fidelity could see, I think they're in a little bit more of a strategic advantage compared to someone like BlackRock, even though BlackRock is obviously the biggest in the market.
Yeah.
I had a question.
I think. Oh, go for it.
It's a detour. So go finish your thought, Carlos.
No, I was just going to say, like the fact that totally unadvertised, Fidelity is already doing more volume than some of the traditional retail plays is, to me, like a really, really, really bullish signal.
Mm-hmm. Yeah. So the question I had was a comment that you made before about oversight and being able to monitor the spoofing that might be happening in the markets. What are, I'm guessing this happens in not just in crypto, happens in all markets, right? What are some of the ways that you can gauge, or what are some of the typical tactics that people take when they're trying to spoof markets, and how do you mitigate that, or how do you observe that?
Funny you mentioned this, Rob. I can send you a paper about it.
Nice.
It's actually quite funny because I get reviews, monthly emails from Certain as a prior member, and that update was that they recently released this product called Hilo, and they basically reviewed JP Morgan's case in 2020 for their spoofing, where they got fined like $1 billion effectively, and they've provided tools. They're working with several different regulators to provide visualizations of spoofing and gamesmanship of the order book. Mm-hmm. And so I think it's not just them, right? I mentioned it. They have a nice paper about it. It shows you the kind of visuals of how you can spot it and identify stuff that's going on. And this one is interesting because it then actually led to enforcement, so you can see how they kind of would detect it. And yeah, they're trying to put that into production across a bunch of different regulated regulators. But I think there's already quite a few. Like FinCEN have their own thing. Like everyone has like a way to try and detect some of these manipulation.
Yeah, I think the thing that I think about more than anything is that it's good to have these metrics in place. And generally speaking, though, I personally believe that the whole concern about spoofing, or the concern about market manipulation in the spot market, is really just sort of like a red herring. You find the same things exist in traditional markets.
I mean, it happens now. Exactly.
Yeah. And without spilling beans or talking about it, like the number of times I've seen gamesmanship in the market, in order books around, options expiries and, fixing windows and all other sorts of things. It's sort of like, it's massively obvious when it happens. And it happens more than you'd like to believe. So to me, it kind of reeks a little bit of like selective enforcement or selective, bias to be like, oh, well, I mean, this could happen in Bitcoin. How do we know? Why? Because we let it happen in all these other markets where we've approved ETFs. So I'm a little dubious of it. I do think it's important to have, investor protections. I do think it's important to do that. But I think if you're going to do that, you need to have sort of a level playing field where you acknowledge the existence of this, like, order book gamesmanship, which is actually somewhat easy to detect, but harder to enforce, because the problem is that, when you enforce it in all markets equally, you find that you end up probably having to give a lot of fines to very, respectable firms. And that might not look good. But it's easy to say, oh, well, Binance are doing it because there's some like foreign entity or something like that.
Yeah, I imagine also like risk aversion too, right? By the SEC. Like, I mean, I think a government job, it's all like downside protection, right? Like just trying to maintain the job. And it's very easy for me to reject things. But if I approve them and something happens, then it's on me, especially with something that's super high profile. So I imagine that, somebody that's, obviously earning, 20% of the salary of a buy side shop, they're just in it for the long game, and they don't really want to take excess risk because they don't need to.
Yeah. I'm going to refrain from commenting on regulatory capture because no one wants to hear me go on another rant, but
Fair enough. But speaking of regulatory, because that seems to be what's in the news lately. Carlos, you shared some article from the Wall Street Journal about something that dropped kind of at an interesting time, talking about some of these ETF submissions and some of the response by the SEC.
Okay, well, I'm going to advise anyone before you listen to the remainder of this to put on your tinfoil hat with me. Because the important premise to this is that the last Friday of every month, the CME does its options expiry reference price, right? And that happens at London 4 p.m., so about 11 a.m. New York time. So keep in mind that today at London 11 a.m. New York 11 a.m., London 4 p.m., there's actually a reasonably large options expiry. Particularly since in the run-up to this, like post BlackRock, the CME has actually become an outsized participant in the market. So that actually indicates that a lot of US-based institutions have been placing bets to move the price of Bitcoin up. And they've been doing so in the futures market. So like open interest is at all-time high. There's all sorts of like things that happen where one could argue that if you wanted to make a little money, you could catch all of this money that's currently chasing Bitcoin in the market up. You could catch them off guard by having an exceptionally low options print below 30K. Mm-hmm. And that might actually cause some adverse effects and potentially some liquidations and some downside gamma in the market. So, with that being said, I found it somewhat odd that 45 minutes before we were trading at 31,000 in Bitcoin, and the Wall Street Journal drops. I'm going to read the headline because I think it's interesting.
It's good.
SEC says spot Bitcoin filings are inadequate on the Wall Street Journal behind a paywall. So literally the market sees this headline.
Can't read it.
And says, oh, fuck. And the price drops down $1,000 immediately. There's a lot of resistance in the market at 30K. They defended the price reasonably well. but then within like, I was actually like watching the market at the time, and so I rang up Matt and I was like, dude, what the fuck? I don't think this is real. And so we dug into a little bit further, and what we find is, and I'll read the paragraph that's like buried behind the paywall, several down. It says, yet the SEC told exchanges that it returned the filings because they didn't name the spot Bitcoin exchange with which they are expected to have a surveillance sharing agreement, or provide enough information about the details of those surveillance agreements. Asset managers can update the language and refile. So the headline basically says the SEC is coming for your Bitcoin ETF.
Sounds like a judgment.
And yeah, and
it's clickbait. It's clickbait.
Flip their shit.
Yeah.
And you read, it's like, oh, actually, you know what? Like, this is pretty normal. Like, and speaking
and
as
perfectly
one who's
reasonable to ask for as well. Yeah.
And speaking as a person who's actually gone through an SEC like regulatory filing before, right? There's back and forth. Like your legal team and the SEC, you're going back and forth. Like there's comments, there's all sorts of stuff. Like, so for this to be like, oh yeah, by the way, like, can you be more clear about this thing? And then for the Wall Street Journal to print, SEC says spot Bitcoin filings are inadequate, and to do so 15 minutes before 45 minutes before a very major, options expiry.
Yeah.
To me, it's like at a minimum, it's poor execution of journalism. And if I put on my absolute tinfoil hat, someone with some influence at the Wall Street Journal really wanted to move the price of Bitcoin to enact a market outcome that they felt would be good for their book. And that to me is pretty chicken shit. I don't enjoy it. Fortunately, the market digested it and went straight the fuck back up after it, actually like looked at it. But
took a while though. It did take longer than I thought. It took a while
for everyone to digest. Yeah, because we looked at it, we're like, that's bullshit. This is not even news. Like, just lift it.
Bye.
Like, let's go.
Yeah. Interesting. As a comparison, I know, Matt, you traded rates and Carlos FX. Those are pretty deep liquid markets. News article, I'm guessing that it's hard to have just like one news article really have significant impact on currencies, or something like this in those markets probably would have less of an impact, I would guess, but maybe I'm wrong.
I guess it's such a nuanced difference though. Like these are, but apart from like the economic numbers that print, I mean, they're really the main ones. Like for me, it was treasuries. So the surprise would be, the US might default, that kind of thing. But everyone kind of knows the news. There's no.
You wouldn't get stuff like this in something like euro dollar or dollar yen or something like that, but you would actually see big price movements off of headlines about emerging market stuff. So
Turkish lira, whatever. Okay.
Turkish lira is the absolute fucking like king of this. Where I think that there are a number of FX dealers that just were kept in business by reliably waiting on some sort of like Turkish lira crisis so they could widen out spreads. But the point being is like, you do see this from time to time. And I think in Bitcoin, maybe as a case in point, to talk a little bit about, PCE that came out today. PCE came out, and Matt had talked about last time how, you really need to watch PCE and see what that looks like. And we were kind of expecting it to come down pretty precipitously. It came down exactly at the rate that Matt said it needed to, which should have been very good for the markets. And you saw, just a very, very, very small blip in the market, which to me basically says macroeconomic factors are now secondary to regulatory filings and legal outcomes, especially as it relates to spot ETF filings, because like we don't give a fuck about like a fantastic GDP or inflation print. But we get really worked up if anyone puts into question the probability that BlackRock might not get accepted on their ETF.
Mm-hmm. Yeah, I mean, there's such a larger fouling, right? Have you seen? So, in your experience now in the crypto markets, Do you feel like you have to follow the news more closely than when you were in traditional finance? Obviously, the market is a little bit smaller, so there maybe there's more things could have more adverse moves. Volatility is much more extreme. I was kind of curious, on the topic of news and moving markets. I thought that would be
I
interesting.
think so. And it's like, where do you get the sources from? Because it, like, Bloomberg kind of has a crypto outfit. There's there's the block. There's a few other places, but they're not. It's not like Bloomberg. Let's put it that way. Traditional Bloomberg, which you have your events going and you can see everything that's coming out almost live. I've not found anything like that really in crypto yet, and I don't think it's big enough that Bloomberg care enough about it to really.
Yeah, I found that like Twitter's good, but you still need to refresh and you need to be very curated about who you follow because there's lots of scam artists on there, and a lot of people that are just like noobs to trading and don't have the real like risk framework to comment on it properly. But that being said, I would say like the difficulty is that you both need to understand macro because it's a macro product in my mind anyway. But you also need to understand sort of like the idiosyncratic things in crypto that are mostly downside. You just need to watch all the time. And the rubric that Matt and I kind of have followed basically is you'll get these like things that happen that cause these big price dislocations up or down, and like full disclosure, we're a quant shop and we run on quant models, and so our goal is not to be trading at a discretionary way, but when you run a model that is prepared to handle sort of these like middle 90% outcomes of trading. And then you get like a random like headline like this that drops the market by, several percent over the course of a second. You just kind of have to be like, all right, well, is this real news or not? So I think compared to FX where you could just let the model run all day, here you need to let the model run all day, but then also understand when there's some sort of like random piece of news, whether it comes in the form of like, Binance, FTX, Gary Gensler, BlackRock, etc. These are all just things that you need to sort of layer on and use to generate a little bit of, I wouldn't even say alpha, just more mitigation of downside risk and trying to understand when things are real.
I guess in quant speak, you could say that the crypto markets just have fatter tails. So you just have to watch for that a little bit more.
Yep. No, for sure. That is exactly the way that it is.
I will say one thing that's interesting is, especially like around any kind of event, you said like, Carlos, with FX, you generally didn't need to turn the models off. You just let them run. In treasuries, we would have to like kind of turn them off. And that was really because the liquidity on the public venues, so the central limit order books, would evaporate. So it would just, so you wouldn't be fully off. You could put orders in still, but you would be super wide. And no one's really trading at those points anyway. I haven't
you want to
really
know why that is? In U.S. Treasuries, at least in the electronic U.S. Treasury space, it's a lot of HFT liquidity. And those guys
exactly.
fuck off whenever.
That's exactly it. So they don't have to do, that's exactly on BTEC and specifically.
And in FX, because you have predominantly banks that provide liquidity, like they just would never run the reputational risk of pulling their pricing. So you have to be there all the time. So you get wide over an event, and that's totally normal, but no one ever pulled pricing. So liquidity was always there. And as a result, the price movements around those events was usually relatively muted as well.
Got it. Yeah. But I was going to say in crypto, like I've never really seen yet like the massive, like spreads are always pretty tight. And that's the thing that's really shocked me, to be honest, in crypto. Like even when the market is vol and there's an event happening, I can still see like a few cents, dollars of spread max for like Bitcoin, and that to me is just crazy. And you know what it is? It's just people doing small limit orders. They want to get filled, and then they'll cross out the arbs somewhere else. So it's like obviously why they're there, but yeah, it's just the scale size at which the liquidity is always some liquidity.
Yeah.
It may not be a huge amount, but there's always something.
It's a byproduct of the fees are too damn high.
One day.
Yeah, one day that'll change. Do you remember that guy that ran for New York mayor, like 10 years ago or whatever? And his whole thing was like, the rent is too damn high.
We've lost that war.
Yeah.
Seem to continue to lose that war here.
So I'm gonna run for mayor of Crypto Town, and my slogan is, the fees are too damn high.
Come on, man.
I really do believe that, like in most crypto venues, if they just sat down and did the math and said to themselves, hold on a second, I could do an exponentially larger amount of volume if I took down my fees a little bit, they'd actually find they do more volume, their platform would be more robust, and they'd make more money on an absolute basis than trying to like hold too firm to this like notion that like people are willing to pay 10 basis points in fees to trade crypto algorithmically. Like it's silly. So like a lot of liquidity in I actually really do believe that a lot of problems for liquidity in the market get solved when you get fee compression.
Interesting. And within Uniswap, for example, what is the spread that you see in those like DEXs versus?
So it's not like spread because it's not an order book, but there's minimum price increments, which I think are like $1 or so.
Okay,
a couple of bucks.
Okay, interesting.
Yeah. The problem with with Uniswap, the pricing is always not super indicative as well, because you pay for most cases you pay about 5 basis points on Uniswap and major pairs, but the price will be so dislocated from like the market price on Coinbase that sometimes that's actually a screaming deal. Like you're totally fine paying 5 bips on Uniswap because it's still a much better price than Coinbase, and sometimes it's just like 10 basis points in price dislocation plus another 5 basis points in fees, and it's not worth your time. So you really
plus
need
whatever
to aggregate
impact
liquidity
for the size you want as well.
Yeah,
you slip in.
So you really do need to look at it on a case by case basis and just kind of look at your best absolute price. But it's a useful tool when it's there.
Boys,
I think we're going to talk about that soon as well, like Uniswap V4, because there's some really interesting stuff with the hooks that are coming out for like doing more automated strategies on the chain itself.
And before we close off, there is actually one really critical piece, which is the Coinbase legal response that I want to get to. Because if we look through sort of like our rubric that we posted last week in the Substack and talked about on the podcast, a critical element of sort of like managing our expectation for like regulatory and legal response of crypto in the US is this ongoing debate between Coinbase and the SEC. As far as I'm concerned, Coinbase is doing God's work. If you have to choose, I've not been historically the biggest fan of Coinbase, but they're winning me over here. But they did something really cool. They brought the big guns. They invested in some extremely talented law firm representation. And we're talking like the big bucks as well. And as far as I'm concerned, they're getting their money's worth. But so they responded to the SEC's complaint. They technically had 45 days to do it. They responded back in like 10, which tells me they either like were working nights and weekends, or they already had this kind of like in the pipeline to go.
Yeah.
But there's a couple things in there that are actually like really good. So the first thing is that they filed not quite a motion to dismiss, but it's called a motion to judge on the pleading, for judgments based on the pleadings. So typically when you go to court, if you file for a dismissal, what you're basically saying is like, I'm only going to reference the charges that were brought against me, and based on those and those alone, I want you to throw this case out. And the likelihood of that happening is usually pretty small, right? More often than not, it's just like a delaying tactic. Coinbase actually did something called a motion for judgment on the pleadings, which basically says take into consideration both what the SEC said and also take into consideration, in Coinbase's case, the 177-page response that we filed. So in that response, they brought up things like the Howey test. They brought up the Hinman emails that were basically where David Hinman from the SEC showed that the SEC felt that once a asset was sufficiently decentralized that it no longer needed to be regulated by the SEC, specifically mentioning Ethereum by name, but could very easily be extrapolated out to the majority of the tokens that were listed on the SEC's complaint against Coinbase. And most importantly, what they also recommended was that there's actually a Supreme Court doctrine, and I'm going to look it up so that I get the name correct. This is a Supreme Court legal doctrine called the Major Questions Doctrine. And what this basically means is that if there is currently a major question of economic or political significance that should be decided by Congress, it is outside of the purview of a regulatory agency to make rules about that and to enforce it, right? Because effectively they're front-running Congress's ability to make laws. So of the people that like I've talked to about this and some of like the reading that I've done on it, this is actually reasonably sound legal framework. I'm not saying it's going to work, but it's an interesting development because really what it's saying is, listen, we have a bill in front of Congress that's going to be voted on. And this bill very clearly articulates the way that our case will play out, right? If that bill is passed, then the SEC actually doesn't have a case because the things that you explicitly stated as being, unregistered securities,
it's no longer the case. Yeah,
no longer the case. So why does the SEC get to front run Congress and bring this in front of us when the Supreme Court has explicitly stated recently that, a regulatory agency cannot do that when there's sitting legislation to be given by Congress, which
is strong.
Makes total sense.
A very strong response.
Yeah. And I think it was quiet. Like people were like, oh, Coinbase responded, and I actually didn't really like look into it until I was reading through a number of like Twitter threads and did my own research, and I was like, oh wow, that's actually pretty solid to me. That like I said, I don't think it's like a open and shut, but as far as like good standing goes, it's a pretty high probability outcome that they'll get a judgment that puts it away. And even if that doesn't happen, I think it's enough to win hearts and minds of people in the legal and legislative community. That's like, why does the SEC get to front run Congress when Congress is currently debating and has an open bill in front of the House Financial Services Committee that solves this problem already?
Yeah, I think this is one of the few legal documents I'm actually going to read, and it's like 177. I got a very small way through it and actually enjoyed reading it as well. It's not written like what I would envision a legal paper to be written in. Very jargony and boilerplate and confusing. It's very clear, describes all the cases, all the casing points very clearly.
Yeah, the only thing they probably could do to make it more readable for Matt is add a bit more latex to it.
Or just put it on an audio book. That would be good.
Yeah,
just imagine some Greek characters too, like put an omega or alpha symbol in there.
Yeah,
that'd be good.
I got some Audible credits coming your way, but
nice
boys, it's great chatting with you guys as always.
Yeah.
Is there anything else? I think we're done.
guys.
I think we're a wrap, right? Awesome, guys. Thank you so much.
America. Enjoy.
That's right. That's right.
Enjoy 4th of July weekend.
I forgot
boys.
It was the 4th. I thought that was just your sign off now. It's like America.
Yeah. Fuck yeah.
Enjoy, boys.
Yeah, have a good one.
Enjoy.
Cheers,
Have a
everyone.
great one. See ya. Happy 4th.